Well, good morning, everyone. This is Tom Marshall for Virginia Estate and Retirement and also the Virginia Tax Center. It's Tuesday, September 24th, and I wanted to give everyone a little bit of update on what our managers are seeing and what the models are seeing and what valuations look like and that sort of a thing. Um, and I wanted to look at things a little bit differently today, probably because we've had some requests to look at the Dow Jones Industrial Average. Different index made up of 30 different companies, and not the usual larger index, but it's been around the longest and it gives us a good idea of what's going on in the stock market as a whole. And what I want to show you on the screen today and some other things we're going to go over is that this is a chart of the Dow Jones Industrial Average from November of 17 through yesterday's close. And what you see essentially is we had this tremendous run up in end of 2017 into January of 18, hit a wall and then came back down, went sideways for a while, came roaring back up in the summer of last year, and then rolled back down, and we actually lost about 19.5% from top to bottom last summer. And we came roaring back up, made slightly new highs, rolled back over, and we're kind of right here right now. This is what's called a lower high. So the problem we have right now is that essentially since January 22nd of 2018 through today, the stock market as a whole is only up 1.3% in 18 months. 1.3% is not a lot given the risk that we're taking and the fact that we've actually had a major decline in here of over 20% means that you had to sit through that and have the luxury of doing that. And so that's why our managers are a bit more cautious right now, because typically when you see this kind of activity, this kind of sideways activity, it means that the large institutions, when values get above a certain level, are not comfortable in owning stocks, and they actually start selling, and then it pushes it back down here. And so that's why you see the managers right now are heavy into bonds and more gold and things like that, because typically this is a pattern that you would either see. The stock market should have blasted off last summer, it should have blasted off this spring, it should have blasted off this summer, and usually what you see is things start breaking down from here. Not always. Got to keep an open mind as the managers are doing, but this is essentially industry jargon would be this is a whack-a-mole pattern. So essentially the stock market came up here, got whacked down, stock market came up here, got whacked down, got whacked here, got whacked here, got whacked here. And so the larger issue is the managers really need to see institutions remaining on the buy side of things and not selling after we get above certain levels, because that's what definitely they're seeing is that they're buying a little bit down at the lower areas, but as soon as we get to the tops, they're starting to sell aggressively again. And so that's what they got to be mindful of, is that this just isn't a sideways range that could last and last and last and last. And so we're heavier into the bonds that pay 5% and things like that, the different bond funds that we've been using for years. So the key thing here is that we've all seen and heard about the stock market has done wonderfully well since January. Well, it has. The problem is that that's January of this year. Since January of last year, the stock market really has gone nowhere. And so that's why we got to be a bit more cautious on how things are doing and things are going. We also have a valuation issue in the stock market right now. This is a chart, many of you have seen this before. This has been updated as of a couple of weeks ago, but it shows the percentage of American household wealth allocated to the stock market. So this axis on the left-hand side is the percentage of American household wealth allocated to the stock market on average. And then the right side axis is the future 10-year returns at that percentage. And then this goes back from 1951 through a couple weeks ago. And what you'll notice here is the gray and the red are very tightly correlated, even though one has to wait 10 years to get a realized return, and we'll talk about that. But a very highly correlated structure here. And so what it's telling us, though, is that right now, the average American household has about 46% of their wealth allocated to the stock market. And the rest of it would be in home equity, cash and bonds and that sort of a thing. The only time we've had a higher percentage was 99 and 2000, right there. And at this level, based on prior history, this level of 46% allocation to the stock market corresponds with a future 10-year return of buying and holding stocks of about 2%. So this is not the time to be all in the stock market by any stretch of the imagination. And you can see, so that's the forecast. The orange is the actual. So the orange always lags 10 years because in order to get a 10-year return, you had to put your money in the stock market in September of 2009. You wait 10 years and then you see what return you got. So it's September of 2019. We see that the average return over the last 10 years is about 14 or 15%. But also back then, the average American household only had about 30% of their wealth, 26% of their wealth allocated to the stock market. So this is an indication that essentially the idea is you want to be buying when everybody else is out and selling when everybody else is buying. And so right now, everybody is buying. Everybody is in the pool. And so because of that, the next 10 years should not look like the last 10 years as far as total return. In fact, there's a lot of risk built into this because it's about a 2.5% total return on average you would see. And what you'll notice here is that there is a very tight correlation between this metric and the stock market performance. And what we like about this metric is that it doesn't take into account, doesn't care what who the president is, doesn't care what interest rates are doing, doesn't care what the tax rates or who's in power in Washington. Essentially, it's saying is that we as Americans, our average household allocation to the stock market will be a function of all those factors. And you can use this factor to kind of find extremes. And so it's the scary thing about this is it's pretty right on over a buy and hold period of 10 years. And so what this is telling us is that we can't be buying and holding over a 10-year period. You actually have to have a plan to get out or to be a little more flexible if you need to be, because this is not where you buy and hold things. This is where you get more tactical, and hence the managers that we're using right now. Another way to look at valuations of the stock market is the Buffett indicator. Now, Warren Buffett didn't create this. He's talked about it a lot. This indicator actually is has been around before Warren Buffett was born. And essentially the idea behind this, and this is a chart from 1950 through a couple weeks ago. And so what this chart is looking at is essentially the stock market should be a function of the gross domestic product of our country. So if our economy is going up, which is measured by GDP, our economy is going up, the stock market should be going up, and vice versa. But sometimes the valuations you pay for the stock market in relationship to the economy can become somewhat detached. And so what you'll notice here is this is just a fraction, these different points on here. And the numerator is all equities that you could buy in the stock market, the total value. So that's trillions of dollars of stock that's available for sale in the whole stock markets in America, all the different exchanges and that sort of a thing. And then you measure it by the denominator, which is the nominal quarterly GDP, and you get a fraction. So right now, it takes about 145% of GDP to buy the entire stock market in America. The only time we paid higher was 99 and 2000 for the stock market. And so the idea here is that, again, when you measure the value of the stock market in relationship to the gross domestic product of the country, this is an extreme valuation that we've only been here one other time before in the past. So this is not the get all in type of a thing. And then what you can do is you can flip that graph upside down, and you can actually get a forecasted return if you buy and hold for 10 years. So this is this chart flipped upside down and projected out using the mathematical equations that you need to do in order to do that. But again, it's from 1950 through a couple weeks ago. Blue is actual, orange is forecast. So the orange here is saying that the buy and hold forecasted rate of return is zero, less than zero actually, if you buy and hold for 10 years, looking at this metric, because we're paying so much for the stock market in relationship to the GDP. your future 10-year returns should actually be negative, forecasted. Now the blue is the actual, and so what you'll notice here is it's pretty tightly correlated going back historically. But this is somebody who put their money in the stock market back in September of 2009. It's now September of 2019, and so they have realized about a 15% annualized return since that time. You'll also notice that sometimes there's a wide gap between forecast and actual. So that was recently, or not recently, but in 2009. We had this in the beginning of the 90s, and we also had this in the late 60s. Economists will tell you that when you see a large gap like that, it typically is the result of government intervention. So in this case, this is because of all the Federal Reserve quantitative easing and TARPs and twists and everything else that they did that actually juiced up the returns more than you would expect. In the 90s, there was a tax cut that happened that caused part of this. And then in the 60s, it was because of the Vietnam War was draining liquidity from the system at different times. And so again, this is just a different way to look at the stock market valuations as a whole. The problem is that this is telling us that unfortunately, if you buy and hold over the next 10 years, you'll be lucky to have a 0% rate of return. This one is actually saying will be negative over the next 10 years if you buy and hold. The only time we were below the zero line historically last summer, and then 99 in 2000. So that's the only time we've ever gotten below the zero line on this metric as far as what to expect for future 10-year returns. And then there's some seasonal things that are coming into place in different cycles and things like that. We don't put a lot of credence on cycles in the stock market until 2 or 3 of them start lining up, and then you start paying a little bit more attention. This is a chart of going back 116 years of what's called the U.S. presidential pre-election year. And so it's the year before the presidential election every year, and it's the average return over that time period. And so typically what you see is kind of a big move straight up into from January all the way up to the summer. Now it says we are here. We did this chart several weeks ago, so we should say we are here. But you have a top typically in January, we have a little bit of a correction, and then you bounce back up into August, September, kind of where we are now. And then typically what happens, you roll over until we get to a bottom somewhere in October or November is typically what's going to happen. And again, if it's just this one, you'd say, well, maybe, maybe not. But you also, besides the presidential election year, you also have the 10-year cycle. And so this is the 10-year cycle. And so this is the first time that the presidential cycle and the 10-year cycle have lined up and are at the same point in the last 20 years. And so now we have 2 cycles that are lining up to be right where they need to be historically. So let me explain to you how this works. This is the 10-year cycle going back from 1897 through 2015. And so this would, you see 0 through 9 at the bottom. So this would be 2019, this would be 2010, same thing could be 1980, 1970, this would be 71, 72. And what they found is that whenever you start a new decade, for whatever it's worth, the first 3 years, 2.5 to 3 years of that decade is sideways to down. And then after the second year of the decade, you tend to start moving up. And then you keep moving up, and then you have a little bit of a correction, kind of like we saw in the last year. And then you blast off, and then you finish the 9-year, 19 type of a thing, 99 as well, on a kind of a high note. And sometimes it's a little bit off. But the idea here is that for the first time, and then it rolls back over. So this would be 2019, so this would be 2020, and it would start back over. So for the first time in 20 years, 2019 corresponds with a pre-election year and also the end, or a 9 decade, that 9 year of the decade, they match. So we actually have these 2 pieces are coming together. So we have 2 cycles that are kind of working together to say a little bit more caution is warranted. And again, you wouldn't put much credence in this by itself, but when you have extreme valuations, you start looking at, well, hang on a second, this is what a typical pre-election year looks like. This is what the 9-year looks like. When you get into the end of the decade, perhaps we need to be a little bit more cautious with how we're doing things. And then we have this. This is actually from Ned Davis Research. Many of you know Ned Davis Research. This is their data model. Let's call their global recession probability model. And they calculate it going back to I think it's 68 on here. That's 1970 at 68 through a few weeks ago. And what they do is you see and you hear all these different data points of purchasing manager index and unemployment and this and that and the other thing. And what they've done is they've created a mathematical model, and it looks kind of like my last EKG when I went to see my cardiologist. But essentially, it just gives you the probability of a recession. So we know right now is when they add all those different pieces from all over the world, the model says that we are currently at 97 on this model. And historically, what that means is that anytime we are above 70 on this model, we have a 91% chance of recession at some point in time in the next 12 months, and we have an 8% chance of avoiding a recession. So this is extreme risk as far as a recession. Again, it's a different way to look at valuations, because if we are entering into a recession at some point in the not too distant future, stocks correct just because of how that happens. And so the idea is then, is it just another data point to say, should we be concerned or not concerned about the economy? And this wasn't saying that essentially, given global data, we should be a tad bit concerned about how this works. And then we have this chart here. Received several questions, emails, phone calls about the yield curve. And so this is actually the yield curve graph here with a few other things to kind of give you an idea of how it all ties together. So the top part of this graph is the S&P 500, and this goes back to 1999, 98 period. This is 2000, then we have 2008, and then we have, here we are right here. And that's fine, it's a good looking graph. But then right here this is the yield curve. And so this is the difference between the 2-year Treasury and the 10-year Treasury. And then I think this is actually the 3-month differential in there as well. And so what they're looking at is where you start getting worried is whenever it's green, it means the longer term bonds are paying more interest than the shorter term bonds. And to give you an idea of how this works, a week and a half ago, 2 weeks, you can actually get a 30-year mortgage at a cheaper interest rate than a 15-year mortgage. And so that reflects in other things as well. And so essentially what it's saying is that the shorter term instruments are paying more interest than the longer term, which is very unusual. It says the Fed essentially is behind the curve. They should start lowering rates aggressively to kind of counteract that. But what you're seeing here is that whenever the yield curve inverts, it doesn't happen very often. It happened in 2007 or 2000, 99, 2000. This is 2007. And it's happening now. And typically the yield curve inverts near the end of a business cycle. You can see this down here, and where it happens is that when it moves up into this kind of danger area in the red zone, and this is the difference between the 2-year Treasury interest rate and the 10-year Treasury. And so now the 2-year Treasury is paying more than the 10-year Treasury. So that's when this happens up here. And then when it rolls over and starts to come back down, as you can see here, that means the Federal Reserve is kind of in panic mode and they have to do something to fix the economy. And that's your warning sign that we have issues. And so right now you can see is that they have a little moving average on this. Whenever this crosses, that's typically the time to get out. And depending upon where interest rates line up at the end of this month, this would be another serious warning sign that things are not all well in economy land. But really what you see is very rarely do yield curves invert. And the last 2 times this has happened since 99, it was a strong warning that the end was nigh on the business cycle. And it was time to start to look for areas to exit, because this is not where you go all in. This is actually where you start harvesting gains and taking risk off the table kind of a piece. And then we have our updated new price to sales ratio of the S&P 500. This is just another way to look at how much are we paying for revenue in the stock market. This is from 2000 through 2000, actually yesterday, through September 3rd, 2019. So this is through Monday, September 23rd. And what this is a graph of all the revenue of all the companies in the S&P 500. How they figured this out is you look at, I know it's hard to believe, but some companies play games with their earnings. And so this just looks at the top line revenue. So you take all the revenue of all the companies in the S&P 500, and then you add it together. And so it's trillions of dollars. So you take up all the revenue of all the companies in the S&P 500, you add it together, trillions of dollars, and then you divide it by the stock value that they have outstanding. And so what's telling us right now is that $2.20 is the number, and that means that it costs $2.20 to buy $1 of revenue in the S&P 500. Very expensive. We haven't paid $2.20 since 1999. We paid it last summer as well, but this is, again, an extreme valuation. It's only been around, we've only seen this value a couple times before in history. We saw it last summer, we saw it in 1999, we saw it in 1987. So essentially, we are really overpaying for the revenue of all the stocks in the S&P 500. Incidentally, what's happening here is this graph, this line on the graph shouldn't be going up. This essentially means that revenue is up 5%, but people are willing to pay 10% more, and 15% more, and 20% more. So we're overpaying for the revenue growth. What this chart should look like is right here. This is from 2004 to 2007. This is the last bull market, and essentially you see the line was flat. Now the market was booming during that time period, but essentially what people were doing is they were saying that, hey, revenue's up 5%, I'm only willing to pay 5% more. And so matched. And so this is really a function of the Federal Reserve forcing people into the stock market because of low interest rates everywhere. So if you had a CD paying 5%, when it matured in 2009, 2010, you couldn't find that yield anywhere, so you went into the stock market to get it. And so now essentially is that we've driven everybody into the stock market looking for yield, and now we're paying $2.20 for $1 of revenue. And we've only paid this level a couple of times before in history. Last time we did pay that much was 1999. And again, it never happens the same way twice, but this is a chart showing the next 15 years after we've seen this before. So we had a good year, a couple of bad years, a bunch of good years, a bad year, and a bunch of good years. So only 4 bad years out of that next 15-year time period. The problem is, so 11 good years, 4 bad years out of the 15. The problem is the bad years are so bad because you paid so much that the average return is only 3.25%. And so the problem then becomes is that historically this is the time period when you do have a major correction. Again, not saying it's going to happen tomorrow or the next day or even the rest of this year. The problem is that when it does happen, it takes you so long to dig out of it and get back to break even that essentially your average annual return is extremely low. So this is actually a danger zone again. Stock markets don't blast off from $2.20 for $1 of revenue. This is typically where they sputter and die. Usually they bottom somewhere down here, and this is where you get a good deal on revenue. This is a chart of the Shiller PE ratio. Dr. Shiller won the Nobel Prize in Economics a decade or two ago about using this idea. And so it's using earnings. So it's price to earnings ratio adjusted for the business cycle is an easy way to understand it. It's from 1880 through Monday. And right now, the cyclically adjusted PE ratio is 29.99. It's really just a good idea to look at it in relation to other past values. So this past summer, it was higher. It was higher in 99 and 2000. And then it was about the same level in 1929 before the crash. So again, this is not a valuation where you want to be going all in on the stock market. This is a valuation where you usually typically get more cautious. And this has been updated as well. Many of you have seen this chart before. This is Bill Hester. I believe he still works over at Morningstar. And his point was looking at when before in the past has the Federal Reserve raised interest rates at least 2 times in a row and then stopped and started lowering interest rates, but the S&P 500 was at a new all-time high. And what you'll notice is these metrics have only happened concurrently about 8 times since 1965. So this is 1965. This is a week or two ago, actually a little bit longer than that. But every time you see a black tick on here, this is where it's happened before in the past, where all these different conditions have lined up. And every time we've had these conditions line up, we've had massive issues at some point in time in the future of being down 36, down 48, down 27, down 34. The only time we've had a miss was the mid-90s. And I would argue that things are a tad bit different now than it was then. Back then, we had a technology supercycle. We went from having computers nowhere to computers everywhere, so that benefited the whole economy. Unless we consider Amazon to be that, and we're all going to be working for them at some point in time, I'm not sure that I can find that we have a technology supercycle that will benefit everybody in the economy because of something going on, and we should have a longer business cycle because of it. So that's a problem. Historically, this is not where things turn out well. In fact, you just have a chance of 1 out of 8, essentially, that historically we will come out of this okay and not have a major decline at some point in time in the future. And then this is an interesting chart that was shared by somebody in the Federal Reserve System that we keep track of. And what they were pointing out is perhaps everybody looking at the interest rates and everything else is not the place to look. The place to look is actually the real price of oil. And this is a chart from 1970 through 2016, I think. Oh, 2008, I'm sorry, 2008. And what you'll notice here, the gray is where global recessions are happening around the world. And almost every time you see a global recession, except for one, it's because of a major oil spike because of whatever happened. So in this case, the early 70s oil embargo, major increase in oil, and then you had so they made a recession. Early 80s, major increase in price of oil, global recession. Early 90s with the invasion of Kuwait. 2000 area, 2000 time frame, not exactly having a problem here. This is actually the mid-90s, early mid-90s, yeah, mid to late 90s. That was the worldwide one, and then this is actually 2000, and then 2007. What you'll notice here is that every time except for one, for as far as a global recession, there was a real spike in oil, real oil price, spike in real oil price. And so what that means then, essentially, as you think about it, it is a tax on the whole economy that nobody was expecting, and so everybody then has to pay it, and that sometimes and oftentimes actually leads to a global recession because of it. And so what remains to be seen is all this issue that's happening in Saudi Arabia with the attack by the drones and the price of oil. Can the Saudis get their production back online quickly? Can that bring the price of oil back down? Or does this maintain a kind of longer term price that's a bit higher than what we're expecting? And so it's kind of a shock to the system. So again, it's something to watch, but again, this is just one more thing you look at and go, that's interesting. A shockingly quick increase in the price of oil. It doesn't have to be long. Actually, many times leads to a global problem as far as recession. And then we have this chart. This is an interesting chart. This is actually from the Treasury Department, and you can tell that because the government doesn't know how to really format their charts, and so this is like the old radio dial we had when we were kids in our car. But this is 1960, 1965, 2010, 2015. So essentially, it's about 1958 through a couple weeks ago. And so what many people don't realize is that the Federal Reserve and the Treasury Department get together and they have a model that they use that predicts the chance of a recession in the next 12 months. And so, and they plot this. They don't tell you exactly how they calculate it, but they release the data. And so some enterprising soul actually plotted the graph or plotted the information, the data on a chart. And what you'll notice, this is just a percentage of chance of a recession in the next 12 months. And then the gray part here is when we had a recession. And so what we found out, though, is that whenever the government says there is a 32% chance of a recession going back to 1958, there's actually a 100% chance of a recession. I guess that's pretty good for government work. But whenever this probability of a recession, according to the Treasury Department's model, hits this 32% line, there is a little bit of a gray area every time since 1960. And so the problem is that we are now at 32% chance of a recession in the next 12 months. And every time we've gotten here before in the past, so again, according to this chart and the past data, whenever the government says there is a 32% chance of a recession since 1960, there's actually a 100% chance of a recession. So again, something else to be mindful of as you look at your holdings and expectations and that sort of a thing. And then here's the glorious toilet paper indicator again. Many of you have seen this before, but essentially the toilet paper indicator looks at good old Procter & Gamble, PG, Procter & Gamble. And as you may know, Procter & Gamble doesn't do anything sexy. Procter & Gamble makes toilet paper and soap. But these are things you're going to buy in a recession and outside of a recession. And normally Procter & Gamble should lag significantly behind the rest of the market during a bull market, because how much toilet paper and soap do you really need? And so what they do then is they track the total return of Procter & Gamble versus an index called XLY. And XLY is an index you can actually invest in. It's an exchange traded fund, and it's actually consumer discretionary things in there. So in XLY, there'll be things like Amazon is in there, automobiles, computers, clothing, dining out. So it's actually things that you want, but you don't need. So the idea here is we are comparing what you need, Procter & Gamble, versus what you want, which is the XLY index. And normally, as I said, Procter & Gamble significantly underperforms XLY in a bull market. And where you get nervous, though, is that when Procter & Gamble starts to outperform by at least 20% over a quarter, because that means that portfolio managers who manage billions and billions of dollars are betting their careers that they would rather own toilet paper than XLY. And if you think about it, it is important because we can stay overvalued for an extended period of time, but when Procter & Gamble starts outperforming, it means these portfolio managers are actually starting to sell certain things that are considered high growth names, and they're actually buying toilet paper. And so if you and I buy Procter & Gamble, nobody cares, but this means that billions of dollars of stock is being sold on of the XLY companies and being repositioned in Procter & Gamble. And again, Procter & Gamble doesn't do anything really interesting, and they've got some management issues and that sort of a thing. So it's not like it's a high growth company that everybody wants to own. But the idea here is that every month they track the total return of Procter & Gamble versus XLY. And when Procter & Gamble outperforms, and every month they track it, but they look back 3 months. So it says rate of change 3 months. And what they're doing is they're trying to figure out when Procter & Gamble outperforms XLY by at least 20%, it's a warning. It means there's been serious buying of Procter & Gamble and serious selling of the companies in the XLY index. And so going back 30 years, we've only had 30 incidents where this was an issue. September of 2000, and then you had September of 99, and September of 2000, October of 2000, November, August of 01, September, October, and then September of 02. So these bottom 7 all were during the dot-com collapse. And this is where the portfolio manager is saying, essentially, we're more comfortable owning toilet paper than we are anything high growth oriented. And that was right here. But interestingly, then it stopped for 5 years. And Procter & Gamble underperformed, did what it was supposed to be doing. So these bottom 7 are when Procter & Gamble was outperforming. And then it stops for 5 years. And now Procter & Gamble is just doing what it should do, is it's just lagging significantly. But then we can start coming into the great financial crisis. So September of 07, November of '07, October of '08, November of '08. So these four pieces are all during the great financial crisis, and this is where Procter & Gamble is outperforming the XLY index again. But interestingly enough, after November of '08, it stops for 10 years. So Procter & Gamble goes back to lagging. It doesn't really do anything. It just kind of chugs along very slowly. And the XLY index significantly outperforms Procter & Gamble. Well, now in November of 2018, we have the first indication that portfolio managers are selling the companies in the XLY index, and they are buying Procter & Gamble. So Procter & Gamble has outperformed by 24% in November of 2018 over the last 3 months. And then though it came close again and happening in July, but what you'll notice if you own Procter & Gamble is that Procter & Gamble hit new all-time highs very recently. So even though the market has come back, if the portfolio managers were thinking that the growth was back on and things are all fine and dandy and we're back to a growing economy, the portfolio managers, what they would do is they would sell their Procter & Gamble and they would buy the companies in the XLY index. They'll get better returns, they'll get better bonuses, their kids can stay in private school and all that kind of thing. But instead, what you're seeing is that though the stock market has come back nicely since January, Procter & Gamble hit new all-time highs last week. And so what that means is the portfolio managers are not selling their toilet paper. They're keeping it, even though they might be buying the other stuff, type of a thing. So that tells you that there's still hesitancy in the people that manage billions of dollars, and they're not quite ready to believe that everything is all clear and everything is good to go. And then finally, this is a chart. Many of you have seen this before. This is a result. A client came in to see us in January of this year and said, I want to put all my money back in the stock market because unemployment is low. And I think the stock market's going to do well from here and we're going to be good to go. And you certainly can do that. And so our response was, let's do some research first to see what we've got. And so this is actually a chart from the Federal Reserve of Dallas. And it's a little bit wonky again, kind of looking at how government sets us up. This is 1990, this is 95, going all the way over here to 2019. And the way this works is that whenever you see red on this chart, this is where unemployment is below 5%. Okay, well, that's fine. That's a wonderful thing. And the idea here is that you put your pen or your finger or your pointer on a point on this line, and then you look up or down. So let's say I invested in 1995. What it's going to say is then if I buy and hold for 5 years, this is all the 5-year holding periods. So if I bought in 1995 and I held for 5 years, that's 2000, I had a 250% total return. If I bought and held in 97 would be about 150%, 100% total return. If I bought and held in 2003, I had a total return of 100% if I bought and held for 5 years. Again, this is a 5-year holding period. What you'll notice is going back to 1990. So again, we're looking at almost 40 years, right? 30 some years. Anytime you buy and hold the stock market for 5 years and unemployment is under 5%, your total return is either barely positive or barely negative. And so it's somewhat counterintuitive, but essentially what it's saying is that the stock market is getting close to the end of the business cycle. You're at full employment. You can stay at full employment for a while, but essentially all the value has been wrung out of the economy, and you have to be very careful going forward of what you do. So again, because if you buy and hold for 5 years when unemployment is below 5%, your total return can be negative most of the time through here, or slightly negative or slightly positive. You want to be very careful. And what you'll notice here is it's a 5-year lag. So this is actually somebody who put their money in 2014, and then this black line will slowly come over here. So you put your money in today, you wait 5 years, and then you get a realized rate of return. So if you were looking at it today, we'd actually would have to wait until 2024 to get our realized rate of return. And so again, another reason just to say, hey, let's be very cautious, be very careful. This actually is a time not to be all in, but actually to be more prudent with your assets. Now, if you're a 20-something or a 30-something, dollar cost average away, just keep adding to it as it goes down. But for those of us who are in, at, or near retirement, we're now on the point where we have to protect the value of our assets and make sure we don't take big losses. Because right now, you're kind of picking up dimes in front of a steamroller. This is not where you go all in, all in. This is actually where you start taking risk off the table. The time to go in the stock market, according to this chart, would be when unemployment was at 12%, which is 2009, and then your total return was from 2009 until 2014 was about 200%. And so again, just another guideline. All these different charts and graphs are using different data, but they're all coming to a very similar conclusion, in that the stock market generally is a good place to be. It's a good place to make money. However, you have to make sure that you don't go all in near the top of a business cycle, because you spend most of your time trying to dig your way out of this type of thing. Incidentally, what typically happens at the end of the business cycle, the asset classes that do the best are bonds and gold. Now, you see our managers have put a little bit more money into gold over the time period, but typically bonds and gold are where you make the most of your money in this part of the business cycle, because things are so volatile and that sort of a thing. But anyway, I hope that helps. And if you have any questions, just let us know, and we'll be happy to answer any and all that you might have. Have a great day.
Chart next. Right now, we're above the center.